It pays for bank stock investors to look a little bit more deeply at company financials, to move beyond the bottom line and get a better handle on what's really happening. Some of the 5 areas we've selected for investors to consider are rather detailed, so I suggest you read the accompanying article. We'll discuss 3 areas to look at in bank financials here. The most important factor distorting banks' bottom line results in the current environment is the release of loan loss reserves. Each quarter, a bank will make a provision for loan loss reserves, which directly takes away from its earnings. If the provision is larger than a bank's loan losses, the loan loss reserves increase. If the provision is smaller than a bank's loan losses, the loan loss reserves decline and the bottom line earnings increase by the same amount. Since most large banks set aside a great deal of loan loss reserves in 2008 and 2009, many are over-reserved, so they're releasing reserves right now and padding their earnings in the process. This is not improper for them to be doing, but it's something that investors need to get a handle on in order to understand what's really going on. In the second quarter, JP Morgan earned $5.4 billion, which was boosted by a loan loss reserve release of $1.2 billion. Citigroup earned $3.3 million with a $2.2 billion reserve release. Wells Fargo earned $3.9 billion, augmented by a decline in loan loss reserves of $1.1 billion. And Bank of America's $8.8 billion loss was somewhat mitigated by a reserve release of $2.5 billion. The next area for bank stock investors to concentrate on is troubled debt restructuring. These are also known as TDRs. A TDR is a loan whose terms have been modified in order to give the borrower a break and in order to prevent a foreclosure and possibly a loan loss. All of the largest banks are carrying a significant number of TDRs on the books. For smaller banks, a potential problem can spring from periodic examinations by regulators. Sometimes regulators will force additional write-downs of the TDRs, and in some cases there have been dreaded restatement of financials. In the accompanying article, we detail one of these greatly. Another area for investors to look at is deferred tax assets. Banks that booked a great deal of losses at the height of the credit crisis are holding a great deal of deferred tax assets in the hope of holding these against future earnings. The problem for investors is if a bank is not expected to quickly return to steady profitability, they may be forced to write down the deferred tax assets, leading to additional losses.